The stock market is currently closed, with the latest regular session closing price for Wolfspeed Inc. trading under ticker symbol WOLF on the New York Stock Exchange recorded at exactly $20.06 per share as of the market close at 4 p.m. Eastern Time on Wednesday, July 29, 2026. During that trading session, the stock experienced a sharp drop of 8.32%, falling by $1.82 per share on an active trading volume of over 6 million shares. Most investors look at this stock right now and assume it is just another struggling semiconductor company getting crushed by the cyclical slowdown in electric vehicle demand. The mainstream headline narrative suggests that as EV adoption cools off globally, suppliers like Wolfspeed are left holding expensive, underutilized fabrication facilities. But that expectation misses what is actually taking place beneath the surface of the order books. The underlying reality is that while retail traders panic over short-term quarterly losses, institutional buyers and industrial power grid developers are quietly eyeing the company's transition to 200mm silicon carbide wafer production. The real friction point here is not whether silicon carbide is superior to traditional silicon, but whether Wolfspeed can manage its massive capital expenditure debt load before those massive automated wafer fabs reach high-yield commercial output. When you open up your favorite individual brokerage or retail trading account on platforms like Robinhood or SoFi Invest, you see a chart that looks brutal over the past year. The broader public market sentiment around Wolfspeed stock has been dominated by fear. Wall Street expected the shift to silicon carbide semiconductors to happen seamlessly alongside the rapid expansion of electric vehicle fleets. Silicon carbide allows high-voltage systems to run much hotter, handle higher currents, and convert power far more efficiently than standard silicon chips. When major automakers initially announced aggressive electrification goals, Wolfspeed was treated as an indispensable technology partner. Investors assumed that building out massive manufacturing plants like the Siler City Materials facility in North Carolina and expanding the Mohawk Valley fab would automatically translate into soaring profit margins. The contrarian truth is that scaling next-generation wide bandgap semiconductor manufacturing is one of the most brutally complex industrial challenges on the planet. Growing silicon carbide crystals requires extreme temperatures, specialized furnaces, and precise chemical engineering. Yield rates for 200mm wafers were bound to face initial hurdles, and those production bottlenecks coincided directly with a period of aggressive interest rate hikes and slowing electric vehicle sales growth. Investors who bought into the early hype expected immediate free cash flow, but the reality was a structural cash burn required to complete massive capital projects. That gap between expectation and reality caused the stock price to compress severely. Looking directly at the recent stock movement, trading sessions over the past few weeks have shown significant intraday volatility. High options volume and heavy institutional trading suggest that big funds are actively re-hedging their positions. Every time news breaks regarding global trade policies, chip export controls, or adjusted auto production schedules, WOLF experiences amplified swings compared to broad sector indices. When you track trading activity across an Interactive Brokers trading account or observe institutional order flows on a Fidelity brokerage platform, you see distinct patterns of heavy volume during price drops followed by quiet accumulation phases. Shorts have pushed the stock hard, taking advantage of high debt levels, while long-term tech funds are weighing the replacement value of Wolfspeed's physical infrastructure against its current market valuation. Comment below how many shares of Wolfspeed stock you currently hold in your portfolio, or whether you are waiting on the sidelines for a clear trend reversal. To fully understand where this stock stands today, we have to look closely at its operational foundation and business model. Formerly known as Cree Inc., the company spent decades operating in the LED lighting and radio frequency spaces before making a deliberate strategic shift to focus entirely on silicon carbide and gallium nitride materials and power devices. The company operates as a vertically integrated manufacturer, meaning it controls everything from growing the raw silicon carbide boules to slicing the wafers, applying epitaxial layers, and fabricating finished power MOSFETs and Schottky diodes. These high-voltage components are critical not just for electric vehicle powertrains and traction inverters, but also for fast charging infrastructure, industrial motor drives, solar inverters, grid-scale energy storage, and modern artificial intelligence data center power supplies. While retail investors using self-investing tools, Robinhood stock trading, or standard online investment apps often group Wolfspeed in with consumer semiconductor stocks like Nvidia stock or Apple stock, its true fundamental driver is industrial power infrastructure. Standard silicon chips excel at processing logic and data, but when it comes to handling thousands of volts inside an electric vehicle inverter or an industrial power grid, standard silicon loses significant energy as heat. Silicon carbide wide bandgap chips operate at far higher thermal limits with minimal switching losses, making them vastly more efficient. However, building out facilities capable of manufacturing these advanced materials at scale requires billions of dollars in upfront capital expenditures before significant revenue can be recognized. This capital intensity created the severe financial pressure reflected in recent balance sheets. High depreciation costs from new factories, combined with elevated interest expense on convertible debt, have kept net margins firmly in negative territory. Past quarterly reports showed substantial cash outflows as construction continued on major manufacturing corridors. Analysts using Fidelity Wealth Management Research or Interactive Brokers fees calculators to assess enterprise value have repeatedly pointed out that Wolfspeed's enterprise value carries significant leverage risks if revenue growth stalls. Yet at the same time, the company's technological position in 200mm silicon carbide substrate production gives it a major structural moat over competitors who are still reliant on smaller, less efficient 150mm manufacturing lines. Moving forward, the future outlook for Wolfspeed hinges on several major catalysts and execution risks that will determine whether the stock can re-rate higher. The primary catalyst is the operational ramp of its 200mm wafer manufacturing facilities. Transitioning from 150mm to 200mm roughly doubles the usable die yield per wafer, which dramatically reduces the cost per chip once yield rates normalize. If the company can successfully drive yield improvements, gross margins will expand rapidly, transforming heavy operating losses into positive operational cash flow. Furthermore, expanded partnerships in automotive traction inverters and new commercial agreements for AI data center power supplies represent major growth vectors outside of standard consumer EV adoption. Conversely, the key risks remain execution delays, customer design win timing execution, and broader macroeconomic softness. If auto manufacturers delay the rollout of next-generation high-voltage architectures, Wolfspeed could face periods of customer inventory digestion, forcing it to carry excess capacity costs longer than anticipated. Additionally, if debt refinancing terms become unfavorable before positive cash flow is achieved, equity dilution remains a persistent concern for retail shareholders using SoFi Active Investing or intelligent portfolios like Schwab Intelligent Portfolios. Investors conducting online investing research must monitor gross margin trajectory and quarterly free cash flow burn above all other metrics. In summary, the market's expectation for Wolfspeed has been framed by short-term cyclical headwinds, heavy capital expenditure burdens, and slowing EV growth narratives. The underlying reality is that Wolfspeed remains a primary supplier of foundational wide bandgap materials needed for the global transition to high-efficiency power electronics. While the stock path has been volatile and punished by debt concerns, its long-term setup depends directly on execution at its automated 200mm production sites.
Investors utilizing Fidelity ETFs, Fidelity mutual funds, Robinhood cash management, SoFi ETFs, or individual brokerage accounts through Interactive Broker Services must carefully separate short-term price noise from the long-term industrial fundamentals of silicon carbide power systems. Understanding this gap between market expectation and operational reality is what defines true long-term investment research. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.